If you're a real estate professional and you're investing in deals because you expect big K1 losses to lower your tax bill, there's a good chance you're missing one of the most important details. Okay, it's the detail most real estate sales pitches gloss over. Most investors don't ask about until tax time, and most offering decks do not explain clearly enough. And if you don't understand this before you invest, you can have a K1 showing a massive paper loss and still not get the tax result that you were counting on. So today, I'm going to show you what those real estate losses actually do, what has to be true before you can offset other income, and why some of them may not help until much later. And I'm Jasmine DiLucci. I'm a practicing tax attorney, CPA, and enrolled agent. I don't just see how people invest in real estate, I see what happens when the IRS reviews it. The denied losses, the reverse positions, the penalties, and passive loss rules for real estate professionals are one of the most confusing and least understood areas for real estate investors. And by the end of this video, you'll understand three things. Okay, first is the pitch, what the sales guy tells you and why it sounds right, the requirements, right, to deduct real estate investment losses as a real estate professional, and finally, we'll look at the strategy, what it actually takes to year over year have real estate losses that offset your entire bill like the rich do. So let's start with the pitch, because there's nothing better than getting tax advice from a sales guy, right? Here's how it usually sounds. Invest in our deal. We're doing a cost segregation study. We'll generate huge bonus depreciation in year one, and you'll get to use those losses. It's the best, especially since you're a real estate professional. And it lands because it stitches together two things that are individually true, right? Real estate professionals can sometimes use rental losses against ordinary income. That's a real tax benefit. And bonus depreciation is real, right? And it can be enormous. So when someone bolts together these two facts, together with a passive investment like in a limited partnership, it sounds like sophisticated tax planning. And the most important part is that it helps the sales guy sell the deal. Now that you understand the pitch, let's talk about the requirements that the sales guy never mentions. Okay, let's start with the default rule. Under the code, rental real estate is automatically passive. It doesn't matter how hard you work, how involved you are, how many hours you put in. By default, a rental is a per se passive activity, and passive losses can only offset passive income. So, what does being a real estate professional actually do? It does exactly one thing. It turns off the automatic passive label. That's it. It doesn't hand you the loss. It just removes the presumption that the rental is passive, and it lets you prove it the normal way like you would with any other business. You meet two requirements to be a real estate professional, right? First, over the year, more than half of all personal services you perform in any trade or business have to be in real property trades or businesses where you're involved. And second, you have to put in more than 750 hours. On a joint return, one spouse has to clear both of these hurdles alone. You cannot blend your hours with the other spouses to get over the line. And here's the part most people then miss. Clearing the real estate professional test does not make your rental losses non-passive automatically. You then have to separately prove that you materially participated in the activity, meaning your involvement is regular, continuous, and substantial. So it's two gates, not one. Gate one, you're a real estate professional. Gate two, you materially participate in this specific activity. The pitch quietly merges them into a single one, right? You're a real estate pro, so you're good. You're not good. You need to clear both hurdles. So let's talk about the strategy, okay? Because certain wealthy people, think Grant Cardone, really do offset huge chunks of their income with real estate losses year after year. That part isn't the myth. Okay, here's the irony. The person selling you the deal is usually the one running it. So those participation benefits are real for them only. They operate the deal. So they materially participate. They take the active seat and they hand you the passive one. And some take it further. They structure the partnership so that the depreciation is allocated mostly to them. So you put up the capital and the deduction it creates lands on their return where it's actually usable because they run the deal and they materially participate. They're taking the tax benefit off of your money. So what actually produces the like a rich result? It comes down to one thing. Being a real estate professional who materially participates in real estate that you actually run. If you do both on the property you actually operate, the losses become non-passive, meaning they can offset your other income, not just passive income. Then you keep acquiring and depreciating property you participate in year over year, and it compounds into a tax result that you hear online, right? That's the engine, real involvement in a real estate business. And if you're going to stay passive, treat it like passive money. Don't expect it to wipe out your active income. Pair the losses with passive income so that they actually get used, and plan the exit because suspended losses free up when you fully sell the property. Because here's what the passive check really buys you. You can't materially participate, so that big bonus depreciation flows through as a passive loss usable only against passive income. Otherwise, it's suspended and carried forward for years. So the depreciation is real. You just don't get to use it in the way you were sold. In your hands, it offsets passive income or just sits there. The people getting the result you were promised aren't writing passive checks into someone else's deal. They're running their own deal. So here's the bottom line. The pitch sounds sophisticated. Real estate professional plus real estate plus bonus depreciation equals a write-off against everything, right? The requirements tell you why that's wrong. Real estate professional status only removes the automatic passive label. You still have to materially participate. If you want real estate losses you can actually offset against other income, the answer isn't a label on someone else's deal. It's your deal. It's a structure where you genuinely participate in the activity or get passive income to absorb the loss. The IRS doesn't care what you call your role in the deal. They care what it actually is.